welcome everyone to the April strategy update call. I cannot believe that we're already through the first quarter. The next thing you know, we're going to be talking about summer vacations, Thanksgiving and Christmas, and we'll be at the year-end 2024 talking about moving into 2025. But enough about me and my age and how fast time travels. So my name is Keith Duran. I'm the Senior Vice President of Business Development, and we're joined, as always, this month with Jim Warner, the Head of Research and Co-Portfolio Manager. Jim, I guess just without further ado, just a reminder for everyone that this is, we do these webinars for you and your clients to give you information about how we're thinking and how we're positioning what we're thinking and how we're positioning the portfolio. So we encourage questions, and you can do so just by refreshing the screen and clicking on the Q&A box at the bottom of the screen. Ask away, and we'll address those at the end of the presentation. So without further ado, and respect for your time, Jim.
All right, great. Well, thanks everyone. Really appreciate your attendance today. We've got a lot of interesting things to talk about. So let me just launch this presentation here. All right. So this month's market strategy presentation is entitled "The Market Broadening," and it's a really, really important theme, and that I think says a lot about the health and the opportunity set going forward, in particularly the equity market. So if we look at basically where we are today, the S&P 500 is up about 10%. And interestingly, and these are all data points as of the end of March, so obviously things have moved around in the last couple of days, but March basically represented the 5th month in a row of the equity indices finishing up. So we've been on a nice rally since the end of October. And this is, where I basically have to make, the point that we can and most likely will at some point have a 5% pullback. We do every single year. And then so as we sort of go into the next couple of months, that's something that needs to be on our mind, maybe trimming winners and buying sort of more value. And we'll talk about exactly what we're doing along those lines as we go forward in this presentation. But the interesting thing to point out here is that, or there's really two things, is that the S&P is actually beating the NASDAQ. This didn't happen all last year, of course. And even in what you've seen in the last month is this really interesting rotation into more value and cyclical industries. And so you can see here in the bottom left that the equal weight, which obviously diminishes the influence of the really large tech companies, is actually up 8%. So it's still trailing the S&P, but it had a big pickup in the last month of 4.5% versus the S&P at 3%. And you can see the NASDAQ at just 1.8. So that's actually an interesting sign that we're shifting maybe towards a little bit more value and trying to find some winners out there that aren't necessarily in the AI space or tech space. Now, the second thing I'll mention on this, and we've kind of mentioned this in months past, but the bond market still just really isn't working. We got a little uptick in the bond index last month, but it's still down about 0.8% for the year. So bonds continue to be a big drag on portfolios. And obviously that's because the market is still trying to figure out exactly where to set interest rates. But we may be getting to a point where we've hit an equilibrium and bonds can start to work as we enter into the rest of the year. So back to this theme or notion of the market broadening. Remember last year, it was all about the Magnificent Seven. And if you own those, you made a bunch of money. If you didn't own those, you really didn't make any money. Coming into this year, and certainly January and February, or really this rally that's happened since the end of October, has really been AI driven, as we all know. And so if you owned NVIDIA, you did great. If you didn't own NVIDIA, you did badly or less great. The stock market's done okay, but a lot of the returns, almost a third of the S&P's returns, have been concentrated and delivered by NVIDIA itself. But that changed in March, and that's, I think, a very good sign. So we look at the year-to-date total returns by sector in the S&P 500. I think the notable sectors that have really picked up performance recently is energy, financials, industrials, and even materials. And I think that's great because that essentially is going to make more of the stocks in the market work, which is it's a really good thing for portfolios in general. Now, what's one of the important things that happened in March, and this also could lead to a better returns in fixed income portfolios, but it's certainly good for overall risk taking, were the comments that Fed Chair Powell made in his post-meeting news conference on the 20th. And basically, essentially what he said was that quantitative easing is coming to an end, quote, fairly soon. The two quotes that really stood out to me during this call, during his press conference, was this one, quote, the general sense of the committee is that it will be appropriate to slow the pace of balance sheet runoff fairly soon. And then he went on to say that there isn't much runoff among MBS, mortgage-backed securities. And so what this really says is that a lot of the headwinds that have been created, particularly in the Treasury and fixed and mortgage-backed security market, has been from this wind down of the Fed balance sheet. Well, this seems to imply that a very positive pivot for the mortgage-backed securities market, which we think should be good. So once you get essentially that seller out of the way, that actually could be a good thing for higher prices and hence lower yields, all of which would be great for particularly the total return bond funds that are in a lot of our models and portfolios. The Fed is also, we think, likely to halt balance sheet runoff before they cut rates. And so that makes this May 1st, the next Fed meeting, really important. And I think where we're going to hear some more details about when and how much quantitative or this runoff and the end of quantitative tightening will come to be. And so the market is, sort of, again, still trying to calibrate, and we'll get to this, but exactly when the Fed is going to start cutting rates and by how much. But these comments are really positive that we're getting closer and closer to that day. So what's driving the S&P higher since, in particular, since the beginning of November, is really a combination of two things. Number one is earnings estimates have been revised upward. And a lot of that has to do with the fact that earnings just and guidance during the fourth quarter earnings season just wasn't as bad as feared. And so that, created some market optimism and positive sentiment. But what also is driving the market up is an expansion in PE multiples. And so I think a lot of this is in connection with these, better than expected earnings and better than expected 2024 guidance out of companies has basically expressed in a lot of negative sentiment about, a recession being right around the corner, kind of unwinding from market sentiment. And so we've seen the PE for the S&P 500 index, this is the forward next 12 months PE, increase pretty dramatically from 18 times to about 21 times. Now, when we put this in contrast to history, you can see that the average forward PE for the S&P 500 since 1997 is about 17 times. So at 21 times, we're a little stretched. We can also look to some technical indicators that it would suggest that, like relative strength indices, that the market may have a tough time. It's certainly set up that there certainly could be a pullback broadly across the index. But given this sort of stretched buying and stretched valuation, but time will tell, and we'll have to see. But as I said previously, it is not uncommon to have 5% pullbacks on literally no news. So we do think that we're getting closer to that day. This is a really interesting slide because what I did here was I took the next 12 months PE ratio for the S&P 500, what you just saw on the previous page, and I subtracted from it the PE for the equal weighted S&P 500. And we've talked about before how the equal weight essentially diminishes the contribution from the Magnificent Seven, which includes NVIDIA and a bunch of AI stocks. And so what this really shows you is that the relative PE, or the difference between the two indices PEs, is really near record levels, which basically means that it's entirely likely that you can find a lot of value still in the S&P 500. It's just not in the leaders, the most recent leaders. And so I think that's part of the reason why you saw a lot of the laggards in financials, energy, and industrials really have a great March. We'll have to see if that continues, but certainly this relative valuation would suggest it may. So from a bond market perspective, we talked about this last month, but the bond market's just trying to fine tune its assumptions on when the Fed is going to cut and by how much. And these are getting, as you can imagine, smaller and smaller recalibrations. The chart on the left is basically what the market implies for the interest rates over the course of the next several meetings throughout the rest of this year. And you can see that in comparison, these two bars are, comparison from the end of February versus the end of March. And you can see that there really wasn't much in the way of adjustment. And you can even see in the 10-year Treasury yield, the yield just is essentially just kind of bumping around the low fours. So there really hasn't been much action in the bond market to speak of. Where we sit today, the market basically expects 2 to 3 25 basis point cuts for the remainder of the year. It depends on the day, whether we're closer to 2 or 3, but that's essentially where we are today. And that's probably a pretty good guess. One of the good things that kind of stability in interest rates provides is lower bond volatility. And that is very good. And it's particularly good, excuse me, for our mortgage repositions, of which we don't have as much as we did before, but this is a very, very good sign for mortgage REITs, which benefit from lower bond volatility. And you can even see in this graph how it's really rolling over and hopefully going back to a more normal level pre the interest rate hiking cycle. And so this pivot by the Fed is going to influence bond volatility in a good way. And as we talked about, the overall market pillars, which are inflation and the labor market, continue to remain intact. The chart on the left is core PCE, the Fed's favorite metric for inflation. And as you can see, it continues to decline and essentially converge to the Fed target of 2%. We're going to dissect that here in a second, like we've done in months before. But also you can see on the right that non-farm payrolls continue to remain fairly healthy. So, you'd have to really squint and look pretty hard to find issues that could really cause a recession. And I'll show you some data that we're looking at that might be the canary in the coal mine. But right now, the economy is looking pretty healthy and inflation's going in the right direction. That's a great market backdrop for risk taking. Now, I created this graph maybe a month or two ago to try to put core PCE into context. Now, as you know, allergies. It's allergy season here in Dallas. Core PCE basically excludes food and energy, so put those to the side. If you can take core PCE, and it takes a little bit of analysis to do this, which is why I haven't heard too many other analysts on the street talk about core PCE this way. But you can actually take apart core PCE into a housing component and a non-housing component. So when we do that, we see that the non-housing core PCE inflation has steadily declined down to 2.1%, which is basically right at the 2% Fed target. So what's causing any core PCE inflation in the first place? Well, it's shelter, it's housing. And you can see that that is declining too. And this is why I spent a lot of time last month, and I'm happy to, answer any questions about this, but I spent a lot of time in last month's presentation about the housing market and why there are some very obvious cracks that suggest that housing prices are going to decline. Not just remain positive, but actually decline. In fact, new house prices, so those in which the home builders are selling, for example, are already down 20% from their peak. So what I would argue to you is the one thing to worry about in terms of inflation is housing, and it's going probably in the right direction. All right, so I talked about how there might be some cracks in the economic armor. Well, there's an interesting situation developing in California, and we're going to have to see how this plays out in terms of the labor market. But one of the things that we can look to in California, not all states do this, is they, under the Worker Adjustment and Retraining Notification Act, they require businesses that are going to conduct mass layoffs to provide the affected employee and the state and local governments with a 60-day heads up. And so we can look at these notices as they're published weekly, and we can get a sense for how many people are going to lose their jobs in the next 60 days. If we look at essentially what's happened, as you can see that the number of layoffs that have happened from California businesses to California workers is actually kind of step functioned up in December and has remained pretty elevated relative to the rest of 2023 in these first few months of 2024. We're just now getting May data in, but we would expect that that is going to probably increase pretty dramatically. Now, one of the things that is driving this, and by the way, we're seeing this across a lot of industries, it's not just one, but one of the interesting side issues that could be creating an acceleration of layoffs in the coming months is the adoption of a new higher minimum wage for fast food workers. And so for, I believe it's stores, for restaurants that have more than 60 stores, the minimum wage is now $20 an hour versus $16 an hour. The problem is not only is this going to impact employment, and there's a lot of news articles you can read about on this at those types of businesses, but it's also going to have a trickle-down effect and hit the more smaller mom and pop restaurants, we think. And it could even spread to impact other industries that employ folks with at the minimum wage level. So anyway, this is just an interesting thing to watch. As you can see, the California's unemployment rate has actually been increasing for almost, well, not quite 2 years, but for quite some time. They're have an unemployment rate of 5.3%, which is well north of what the national average is. So when we get to portfolio positioning and how this all influences the way we're investing, the market backdrop, as I said, is still generally favorable. We've got inflation heading lower, which means lower interest rates eventually, particularly on the short end of the curve. We've got the economy still chugging along, the labor market, consumer spending are still very strong, but we do see some gathering clouds, one of which I just alluded to in California. But there are obviously these particular sectors like artificial intelligence. Another one is the growing need for electricity that's getting a lot of press, that we've been invested in that theme for quite a while. These are industries that are experiencing generational surges in demand, and it isn't just like overnight demand that'll go away tomorrow. These are multi-year, decade-long type demand increases for various businesses, and we love to play in places like that. So our short-term view hasn't really changed too much from last month, although while we've expected this rally and it has happened, the equity markets could keep rallying. If that were to happen, it's most likely going to be because people continue to play catch up in buying laggards, as opposed to keep chasing the high momentum names. But time will tell how that plays out. But it's still a great time for risk taking. We think that bonds will start to do a better job. As I mentioned, we've kind of had a big readjustment to slightly higher interest rates from the beginning of the year. This kind of sets up yields in bond portfolios to be in a good place. So we'll see how that materializes, but we are, fingers crossed, hopeful that the bonds will start to pick up performance. Our medium-term view, sort of late summer, fall kind of time frame, it's entirely likely that equities will start to face some headwinds. It's not uncommon for the market to experience increased volatility ahead of a presidential election. Generally speaking, though, markets go up in presidential election years, no matter who wins. But that's obviously going to create some uncertainty for the market, uncertainty around policy in particular. We may also get some, we will certainly get some more information on home prices and whether or not, they are actually coming in as we expect them to. And all these things will start to then play upon how aggressively the Fed may need to cut rates. So the really negative scenario here that we have to sort of keep an eye on, it's not our base case, but we have to always be aware of potential risks, is that housing prices really collapse and we see a real big drag down on the core PC overall, to the point where the Fed has to get very aggressive in cutting rates. And the other thing too is we still haven't seen the full impact of higher interest rates running through the economy. So typically, it takes about 18 months after, a rate cut to really process for the economy to process that rate cut. And we haven't gotten there yet. And so it's entirely likely that we could see building economic headwinds as well, which could create some uncertainty. And, given the good start that we've had to this year, it would not be, unprecedented for people to trim their winners and bank their profits. So time will tell what happens there, but we're keeping a watchful eye out for that potential volatility. And then lastly, of course, is the election. It's a huge wild card. The way we tend to think about elections around here is not so much as to who wins and whatnot, but what that individual's policies may be and how existing funding could be rewired. So the example I've been giving for the last couple of weeks is the Inflation Reduction Act, which provided huge amounts of subsidies for renewable, well, particularly for electric vehicles. Does that get rewired somewhere else? And so these are important things to pay attention to, as beyond simply the stump speeches, but what we actually think could happen practically, at the policy level. So from a global vigilance positioning standpoint, I think we made a number of different changes. I'd say overall the theme here is that we remain pretty balanced. We remain kind of in this 55 to 60% equity allocation. One thing we did was we exited one of our larger bond positions to raise cash to increase our bet on gold miners, which I'm going to talk about here in a second, to add to names like Eaton that are huge winners in the build out of additional data centers. And we also initiated a new position in biotechnology, which, if you really stop and think about who some of the big winners could be of artificial intelligence, biotech has to be near the top of that list. AI has the promise, of course, we haven't really seen it yet, but the promise of really accelerating the efficiency and the speed of drug discovery. And if that happens, biotech will be, obviously an enormous winner. One thing I would also mention is that we actually have raised a little bit more cash than normal, because if we do get it, if we do get a bit of a dip in the market, we can then redeploy that, and take advantage of that dip. And then, I put this in last month, but and put it in again this month. This is our tilt portfolio. So it's becoming very popular amongst advisors and clients. It's a more aggressive version of the moderate version, which I just showed you. We have a lot of the similar positions, but where the tilt portfolio differs from the moderate portfolio is, number one, most obviously, is an equity allocation. We're up over 80, near maybe 85% equities in this portfolio, so many fewer bonds. But we also will use riskier names. So, for example, in the regular portfolio, the moderate portfolio, we have an allocation to Lockheed Martin. We love Lockheed Martin. It's really interesting. They're in all the right programs, et cetera, et cetera. But in the tilt, what we chose to do was add a higher beta name, a company called Kratos, which makes basically does a number of things in terms of orchestrating military satellites and communications, but it also makes these drones that are almost the same size as an F-35 that can fly along with them. And their drone business is we think, poised for a lot of success. But you can see that what we're doing is taking a slightly riskier view on the overall defense theme and kind of global remilitarization theme that is present in the moderate portfolio. So I mentioned I talked just a little bit on gold miners. We love gold. Gold's done terrific for us. It's not only a great hedge in the portfolio, but it also, if the dollar actually starts to roll over, we think gold will continue to do well. One thing also that's propelling gold forward is central bank buying. In particular, China and India are buying lots of gold. So this is pushing gold prices up. What's interesting, though, is that it hasn't pushed up the stock prices of the gold miners. which is very interesting because historically speaking, when gold prices go up, gold miners are supposed to go up a lot more. Why? Because obviously they've got a lot operating leverage, financial leverage. You can't just go discover, it's hard to go discover new gold supplies and bring it to market. And so the spot price of gold, when it goes up, it really drives much higher earnings for the gold miners, and hence the stocks usually work. Well, they haven't this time. It's very unusual, but if you look at the relative stock performance, which that's what this graph suggests, is that you've got, it's basically at near the relative price between gold miners and gold is near its lowest levels in quite some time. And so we think that this is a really kind of exciting way to supercharge our gold bet, which is, owning the miners. So we've been aggressively adding to that position. This is my last slide, and then we can take questions. So start thinking about what you want to ask. I think one of the most compelling things that we have to think about as investors over the course of the next probably 2 years is where is all this money market money going to go? So as the Fed starts to cut money market, rate or Fed funds rate, one of the first asset classes that gets hit is money markets, right? So right now it's very easy to just go say, I don't really have a great idea, or the market's a little overcooked. I'm just going to stick some money in cash. I'm earning a pretty good return on that. Well, that's going to change, right? That return is going to become less and less attractive relative to other opportunities. And so you can see that since the start of the pandemic, basically money market assets have gone from about $3.5 trillion to over $6 trillion. That's a lot of money that needs to eventually go find another home. And whether that's, that's going to be probably some combination of stocks and bonds. So this, from my perspective, really lends credence to the idea that any dip in this market, there's plenty of cash to buy that dip. And so in some ways, I look at this as a little bit of an insurance policy. When we get dips, that there's money on the sidelines that can come in. So I think that's an exciting thing that we can think about over the course of, the next 2 or 3 years, however long it takes for, this bubble, if you will, in money market assets to unwind. So, Keith, let me stop there and let's take some questions.
Sure. We'll give us a chance just to have people type out a question, but I kind of have, while we're waiting, just to see if we get anything. This is me. I just kind of, I'm interested to know if whether or not you can pull out. We pulled out housing out of core PCE. Can you, what about food and energy, right? Because I go to the grocery store and I still think like, holy crap, the cost of food is just crazy. Is there a way to pull that out, or is there a way to pull that out, or what is inflation if you add those back in?
Yeah, so it's actually, believe it or not, energy and food broadly have shown, energy has basically shown essentially deflationary prices over the course of the last, number of months. And even food is showing deflation in certain categories of food. And then there are other categories of food that are still kind of surging along, like beef, for example. But eggs are actually in sort of a deflationary mode. So it's a little bit of a mixed bag. I think what you are feeling is, and what every other person feels when they go into the grocery store, is that they just haven't come down really overall from the, where we were in 2020, or 2019, right? We sort of, and this is really, you could say this across a lot of categories of goods, just all the prices got reset upward and they just really haven't given us anything back, So I think that's part of what you're feeling. Now, I mean, in terms of our forecast for either one of those things, it's been really tough for farmers. I mean, this has been a bad year for agriculture. And obviously a lot of that has to do with the weather, and the weather is really impossible to predict. So it's hard to know exactly what the direction that overall food prices will go. Energy is kind of a different story, right? We've had a total collapse in natural gas prices. But unfortunately, given where storage levels are, given again, there's a bit of weather that plays into this, but it's not looking particularly great for natural gas. At least we haven't seen the factors kind of accumulate to be more bullish on that. Oil, however, might be a different story. We could see that climb over the course of the summer months, and so my mind, goes straight to, gas at the pump, right? What do those prices do? And we could see, them pop up here in the summer. Um, do those two things overall derail the Fed from having a few cuts this year? I don't think so. But it isn't going to make it any easier on the consumer because they're going to have to they may have to make some more difficult choices about how they spend their money. And, again, all this becomes more important if the labor market really cracks and we see higher unemployment. That's when these issues become particularly acute. But for now, we're just sort of waiting and watching. We're long some oil and gas names, and those have actually done very well in the last month or so. But there's a way that we can actually play it from a stock perspective that turns a negative for the economy into a benefit for our portfolio, unfortunately. But or fortunately, however you want to look at it.
Yeah, gotcha. Thank you. It looks like there's two questions. You mentioned the electrification and energy theme. How do themes get created?
Yeah. Yeah, we get this question all the time because, a lot of folks, a lot of the way we invest our equities, in particular, is based on secular themes. What we like, because we believe that this not only creates, kind of a different, less cyclical earnings driver, but it also has usually some length to it. So, one of our themes from, that we initiated a few years ago was artificial intelligence and the digitalization of corporate America and the adoption of cloud computing and all that sort of stuff. And so as we did the work, and we were separately investing in LNG exports because there's a huge need in Asia and in Europe to move to a cleaner burning electricity generation source, and LNG fits that mold. What happened actually is that these two kind of worlds are sort of kind of joined or colliding. And, the way we sort of talked about it, if you think simplistically, power drives GDP, right? If you can't power industry, then you can't have economic growth. And what's actually happening, and it's going to become a more and more acute issue, particularly as data centers for AI are created, and there's a huge pipeline of them coming. As more and more people drive electric vehicles, as just more and more goods are electrified, we don't have a grid that's big enough and has the capacity to handle all this. And so electrification is creating enormous amounts of demand for these are in some cases stodgy industrial companies and their products, because you need them to build the electricity generation that is required to do all this AI in the future. And so it's a really big part of, it's become sort of an expanded thesis, but you can see how our thinking kind of as we learn more and more about the applications and the usage of energy required for AI, it sort of drove us down this path. And so, sometimes we have themes that sort of just emerge, like the remilitarization and increased global defense spending, and that kind of becomes obvious. When you start to see things like Japan remilitarizing, that's a big deal. But then sometimes you get these themes that just sort of emerge as you learn more about an existing theme. So there's almost an evolutionary aspect to it.
Yeah, makes sense. One last question. Now that there's been a positive pivot in the MBS sector, will you begin to add that back into the portfolio?
Yeah, so the way we're thinking about it is oftentimes we're early to market trends. And certainly we were early to predicting that the bond market would be a good place to put money. It may very well be now, but this is a theme that would be, is only weeks old. And so I think what we want, and because a lot of the rest of the portfolio is performing well, before we sort of start picking away at that capital and reallocating it back to mortgage-backed securities, we'd also need to become a little bit more concerned about where the equity market is from a valuation standpoint, and also the economic data, that underpins it. So, there's a lot of things that we like that we don't have capital allocated to, but because we run a bit of a concentrated portfolio, it's really supposed to represent, the holdings there are really supposed to represent our best ideas. And right now we're just not quite there. But we do still have mortgage-backed security exposure. It's just at this point we haven't gone back to the well and increased that.
Yeah, that's great. It is a portfolio of best ideas, not sort of mediocre ideas. With only 30 securities, you got to have the best in there.
Right.
So that's perfect sense. It looks like that is all the questions. So with that, I just want to, on behalf of Lear Investment Management, thank everybody for taking time out of your day to join Jim and I. And before not too long, we'll see you back here in May. Holy cow. So thanks, and everybody have a great day.
Thanks, everyone.